Here is a question that almost nobody asks out loud, but almost every Canadian homeowner thinks about quietly, usually late at night, usually after opening a mortgage statement. At what age will I actually be free of this thing? Not when the bank told you it would be done. Not the number you wrote down on that optimistic little amortization schedule when you first signed the papers. The real age. The honest number. The one that factors in the refinance you did in 2019, the home equity line of credit you tapped for the renovation, and the fact that you bought your first place a decade later than your parents did. Because here is what most Canadians are quietly discovering, often well into their 50s and 60s, the finish line keeps moving. And today, we are going to talk about exactly why that happens, what it actually costs you, and how a smaller group of people are breaking out of the cycle while the majority are still running on that treadmill. Let us start at the very beginning. The moment you decide to buy. If you grew up in Canada in the 1970s or 1980s, you probably watched your parents buy their first home in their late 20s. That was the norm. The typical first-time homebuyer back then was around 29 years old. It felt like a natural step: finish school, get a job, get married, buy a house. The whole sequence fit neatly into your 20s, and the mortgage was supposed to be wrapped up well before you hit retirement. Fast forward to 2026, and that picture looks almost unrecognizable. The national median age of a first-time homebuyer has climbed to 36. That is 7 years later than a generation ago, and in some markets, it is far worse. In Ontario and Montreal, the median sits around 39 to 40 years old. And in Vancouver, brace yourself, the median age of a first-time buyer has reached 46. 46. That means half of all first-time buyers in Vancouver are purchasing their first home after their mid-40s. Let that sink in for a moment. Now, why is this happening? The answer is not complicated, but it is painful. Home prices in Canada, particularly in major urban centers, have risen so dramatically over the past 2 decades that saving for a down payment has become a multi-year, sometimes decade-long, project in itself. To avoid mortgage default insurance, you need a 20% down payment. In Toronto, that number is now over $220,000. In Vancouver, it is over $240,000. That is not a down payment. For many people, that is their entire net worth in their early 30s. And so roughly 30% of first-time buyers in Canada are now relying on financial help from their families to even get through the front door. The bank of mom and dad has become one of the largest mortgage lenders in the country, unofficially, of course, but effectively, so the starting gun already fires late. And when you start a 25-year race at 36 instead of 29, the math changes dramatically. Suddenly, that finish line is no longer at 54 or 55. It is somewhere in your early 60s, assuming everything else goes perfectly. And as we are about to discuss, things rarely go perfectly. Before we get into all the detours, let us talk about the cost of the mortgage itself. Because most people significantly underestimate what they are actually paying when they borrow money to buy a home. Picture a standard scenario. You borrow $500,000 at an interest rate of 6%, amortized over 25 years. Your monthly payment is manageable enough that you can budget around it. But here is what the total picture looks like. By the time you make your final payment, you will have sent roughly $960,000 to your lender. You borrowed $500,000. You paid back $960,000. That extra $460,000 is pure interest. It never touched the principal. It never built your equity. It simply walked out the door every month and into the bank's balance sheet. I like to call this your silent roommate. You cannot see this person. They do not help with the dishes. They do not chip in for groceries. But every single month, they quietly take their cut of your paycheck before you see a dime of the benefit. On a standard 25-year mortgage, that silent roommate costs you roughly $18,000 a year, every year, for a quarter century. Now here is where people make a very common and very costly mistake. When monthly payments feel tight, and with today's rates, they very often do, the instinctive solution is to extend the amortization. Spread it out over 30 years instead of 25. The monthly payment drops, which feels like breathing room. But what actually happens to that silent roommate? On the same $500,000 mortgage at 6%, stretching to 30 years does not just add 5 years of payments. It pushes your total interest to $570,000. You have saved a few $100s a month in the short term, and you have handed your lender an extra $110,000 over the life of the loan. That is not a minor adjustment. That is a car. That is a couple of years of retirement income. And millions of Canadians are making exactly this trade without fully running the numbers. Now let us talk about the part of this story that almost nobody discusses when they buy a home, the midlife detour. Or more specifically, the refinancing trap. Here is the thing about a 25-year mortgage. It assumes your life stays relatively stable for 25 years. It assumes you buy one home, keep it, make your payments dutifully, and cross the finish line. But that is not how most Canadian lives actually unfold. Roughly half of all Canadian mortgage holders adjust their terms at some point midway through, refinancing, tapping into home equity lines of credit, or upsizing into a larger property. And every single time that happens, the clock resets. Think about the most common scenarios. You have been in your starter home for 8 years. The kids have arrived. The space feels tight. You decide to upsize. You sell the smaller place, take the equity, and roll it into a new property with a new mortgage. A fresh 25-year amortization. You are now, let us say, 42 years old. Your new finish line, age 67. Or maybe you stay in the same home but refinance to pull out equity. The roof needs replacing. A child needs tuition. A renovation has been on the list for years. You refinance, unlock some of the equity you have built up, and in doing so, you restart the amortization clock on the new, larger balance. Every one of these decisions feels completely rational in the moment. And often, it is. These are real needs. But the cumulative effect of a lifetime of these small resets is that the actual median payoff age in Canada is no longer 54 or 55. It has drifted into the early to mid-60s for the national average. And for people in major urban markets, particularly those who bought late and refinanced along the way, the real number is pushing towards 70. 70 years old. Still carrying mortgage debt. In what were supposed to be the peak retirement years. So what can you actually do about it? Let us spend some time here, because this is where the conversation gets genuinely useful. The good news is that most Canadian mortgages come with built-in tools to fight back against the interest clock. They are called prepayment privileges, and most people are not using them anywhere near their full potential. Here is how they work. Most lenders in Canada allow you to make a lump sum payment against your principal once per year, typically between 15 and 20% of the original mortgage balance, without any penalty. They also allow you to increase your regular monthly payment by a similar percentage annually, again penalty-free. Now consider what even a modest use of this privilege does. If you add just $200 extra per month to your payments on a $500,000 mortgage, you will cut approximately 4 years off your amortization. And you will save around $85,000 in interest over the life of the loan. $200 a month. $85,000 in savings. That is not a financial trick or a loophole. It is simply math, getting more of your money hitting the principal earlier, so the interest has less to feed on. Another tool that is underused and almost embarrassingly simple is accelerated biweekly payments. Instead of making 12 monthly payments per year, you make 26 biweekly half payments. The arithmetic works out so that you effectively make one full extra payment per year without it feeling like you are doing anything significant. And the result? On a standard 25-year mortgage, accelerated biweekly payments shave close to 3 years off your timeline. 3 years of freedom, earned by changing nothing except the frequency of your payment schedule. Then there is a more sophisticated option that is common in countries like Australia and the UK but is quietly available in Canada as well, the readvanceable mortgage structure. Products like the Scotiabank Step or the Manulife one are built around the idea of routing your income directly against your mortgage balance. Instead of your paycheck sitting in a checking account earning nothing while you separately make mortgage payments, your entire income temporarily reduces your outstanding balance. Your daily balance is lower, which means interest accrues on a smaller number every single day, and the savings compound over time. It is not for everyone, it requires discipline and a clear financial picture, but for the right household, it can replicate what Australians call an offset account, and it is a genuinely powerful way to shorten the debt timeline. Now let us get to the part that is most striking, because it involves a gap between what Canadians believe and what is actually happening. When bank surveys ask Canadians when they expect to be mortgage-free, the most common answer is around age 58. That is the dream. Pay off the house, walk into retirement with no debt, spend the later years in a home that is truly yours. The reality, according to Statistics Canada, is considerably different. Only about 34% of Canadian homeowners own their property outright, with no mortgage at all. That means roughly 2/3 of homeowners are still carrying debt. And in the supposedly high-earning prime bracket of 45 to 54-year-olds, only 22% are mortgage-free. Less than 1 in 4 Canadians in their late 40s and early 50s has fully cleared their mortgage. Total outstanding Canadian mortgage debt has climbed to roughly $2.3 trillion. That is trillion, with a T. It is one of the largest household debt loads, relative to income, of any country on earth. So the gap between expectation and reality is not small. Canadians expect to be free at 58. They are actually clearing their mortgages, on average, in their early to mid-60s. And for those who started late in Vancouver or Toronto and refinanced along the way, the number can stretch well into their late 60s or beyond. But here is where the story takes one final turn. The one most people do not see coming. The quiet secret that actually explains those high ownership numbers among older Canadians. When you look at the statistics for Canadians aged 65 and older, the outright ownership rates look surprisingly strong. More of them own their homes free and clear than you might expect given everything we have just discussed. And you might assume that means they simply grounded out, made their payments, stayed in the same house, and eventually crossed the finish line. For some of them, that is exactly what happened. But for a very large number, the real story is different. They did not pay off their original home. They sold it. The most common path to mortgage freedom in Canada is not a final monthly payment. It is a final transaction. A family in Toronto or Vancouver reaches their late 50s or early 60s, the kids have left, the house is too big, and the equity in that property has grown to extraordinary levels. They sell. They take the windfall. They move to a smaller city, a smaller home, a more affordable community, and the capital from the sale wipes out any remaining debt in a single moment. This is downsizing as a financial strategy. And it works. It genuinely resolves the debt. But it also means that the mortgage freedom many Canadians experience is not actually the product of patiently paying down a 25-year loan. It is the product of selling a highly appreciated asset in a market that grew faster than anyone anticipated. That raises a question worth sitting with. What happens to the generation that bought later, in a market that may not appreciate as aggressively as the last 20 years? What happens if the sale price is not as dramatic, or if they downsize once already and do not have that windfall available? The safety net that rescued earlier generations may not be there in quite the same form. So let us bring this all together, because there is a clear through line to everything we have covered today. Canadians are entering homeownership later than any previous generation, sometimes a full decade later than their parents. They are borrowing more, paying more in interest, and encountering far more midlife events that reset their debt timeline. The dream is mortgage freedom at 58. The reality is closer to 65 or beyond. And even many of those who achieve it do so by selling rather than finishing. None of this means homeownership is a mistake. For most Canadians, a paid-off home remains one of the most powerful financial assets available in retirement. The equity is real. The security is real. The fact that your housing costs drop dramatically once the mortgage is gone is genuinely life-changing. But getting there requires being honest about the timeline, ruthless about the refinancing decisions, and deliberate about every tool available to you: the prepayment privileges, the accelerated payments, the smarter mortgage structures. Because the bank's default plan, the one that just asks you to show up and make minimum payments for 25 or 30 years, is not designed for your freedom. It is designed for their profit. The Canadians who are clearing their mortgages ahead of schedule are not doing it because they earn dramatically more than everyone else. Most of them are doing it because they understood, very early on, how much that silent roommate was costing them, and they decided to evict it. That is what this channel is about. Not just knowing the numbers, but knowing what to do with them.